I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, mixed messages. The U.S. Department of Justice is leaning against approving the $26 billion merger between Sprint and T-Mobile, while the chair of the FCC has endorsed the deal. We'll tell you what's next. Plus, Google is cutting off supplies and services to Huawei, along with a slew of U.S. chip companies, the latest in the saga of the blacklisted Chinese telecom. And Tesla stock falls to its lowest level in more than 2 years as concerns pile up about growth. One analyst calls it a code red. First, to our lead in a Bloomberg scoop, the U.S. Justice Department is leaning against approving T-Mobile's proposed takeover of Sprint because the concessions the companies have proposed do not go far enough to mitigate antitrust concerns. T-Mobile and Sprint are planning to announce commitments including asset sales and a restriction on price increases to help secure regulatory approval. Shares of both companies dipped when the news broke, but finished Monday's session in the green. Meantime, FCC Chair Ajit Pai said he'll recommend approval of the deal. I want to bring in Bloomberg's David McLaughlin, who broke this story, and Peter Adderton, founder of Boost Mobile in Irvine, California. So, David, first of all, where are we now? Who has authority, the FCC or the DOJ?
Well, approval from both agencies is needed here, as well as from state attorneys general who are investigating this merger. It's very common in telecom deals to have both the Justice Department and the FCC review a deal. And they both have different standards when considering approval. The DOJ is focused on competition. Will a merger lead to higher prices for consumers? The FCC has a much broader standard. That's the public interest standard. Typically, they come out on the same side of a deal. They work very close together. And here it looks like DOJ is leaning against the deal, while the FCC chairman today announced that he intends to recommend approval.
Interesting. Peter, obviously this has been a long time coming. There have been many twists and turns. Both companies have suggested concessions that they can make, but it sounds like the DOJ doesn't think there is enough. What is your perspective on whether this is good or bad?
Well, it's interesting because I actually spent a lot of time meeting with the DOJ, Department of Justice, and also with the Chairman Pai and the commissioners. And, the DOJ is concerned about the anti-competitive nature of this merger. And one of the things we were pushing for was the divestiture of Boost. I was quite surprised to read that article today on Bloomberg, because I actually thought that the divestitures they offered, i.e., divesting Boost out, was actually something that the DOJ would have actually saw as a positive. I mean, I'm not concerned about whether Sprint, the new T-Mobile, will actually go after Verizon and AT&T on the postpaid side. I think every one of them wants a high-paying ARPU customer on postpaid. I was always concerned about the prepaid, and I made that point across to both the DOJ and to the FCC and the commissioners, and I think the commissioners have made the right decision, well, the ones that have come out for the merger with the divestiture, because it really does protect the low-income customers, which are the ones that we need to be concerned about. The high-end customers, the high-end postpaid customers, that T-Mobile, the new T-Mobile, is going to be fighting tooth and nail with Verizon and AT&T to get those customers. It was the prepaid part, which Verizon does not play in. I think they got less than 5 million subscribers. AT&T's only just started to warm up to it. And no doubt that T-Mobile and Sprint had the lion's share of those prepaid customers. So I was very surprised, because I actually thought the DOJ would have liked that. The other part which was quite surprising was there was no mention of divestiture of spectrum. I felt that would have been something that the DOJ actually would have preferred to have happen, because that would have allowed, I think, a lot better conditions for this merger to go through. So I was surprised that wasn't mentioned, but having said that, they made the right decision on the divestiture of Boost.
Right, and the promises that they have made, as I understand it, David, the sale of Sprint's Boost prepaid brand, Peter, which is what you're talking about, a 3-year build-out of advanced 5G, and that they pledge to not raise prices while that network is being built. David, where do those promises stand, including Boost?
Well, those are the kind of promises, except for the divestiture of Boost, those are the sort of promises, those sort of behavioral conditions that this Justice Department has made very clear it doesn't like. And that was an issue that came up when AT&T tried to buy Time Warner. last year, and the Justice Department sued to block that deal. It's possible here that the companies could make additional divestitures that would satisfy DOJ. It's not unusual for the Department of Justice to look for a different remedy than another regulator. We saw that there's sometimes a split with the EU and DOJ. So that's possible here. So you could see maybe another one of the prepaid brands being sold, or possibly Spectrum. We haven't reported on that, but that's always a possibility as a way to get Justice Department on board.
So, Peter, if this deal doesn't happen, what does that mean for your business, and vice versa if it squeaks through?
Well, I think the question's got to be asked. The statement that they made today about the divestiture of Boost was kind of like a 30,000-foot level statement. There is a lot of devil in the details. There's no point just spinning out Boost and then giving it a wholesale deal that doesn't allow it to compete. The other question is, who's allowed to buy it? Is AT&T and Verizon allowed to buy it? Is TracFone, who's a competitor to América Móvil, the Mexican-owned carrier, who's a competitor to Boost today, able to buy it? I mean, there are so many questions that need to be asked. And then who's going to police those? So who's going to ensure that you get the best MVNO deal you could possibly get to be able to compete against the Metro brand? So I think there's a lot of details that hasn't seemed to be brought out right now. And then who's going to police that? Who's going to oversee to make sure that the deal that the new owner of Boost gets the right ability to be able to compete? So, I'm still waiting to hear the details of what that's going to be. Is that just going to be left to the new T-Mobile to sort out? Is the FCC going to play a role in that? If the DOJ comes on board, are they going to play a role in that? Because, really, there are certain people who should buy it and there are certain people who shouldn't be buying it. So I'm really interested to see the details, because at this stage, they're very light.
Meantime, David, the FCC would still need to vote on the deal, even though the chair has said he would endorse it. We spoke to FCC Commissioner Brendan Carr earlier on Bloomberg Television. Take a listen to what he had to say.
Part of our years-long review at the FCC has been looking at competition issues. And when you look right now, a combined Sprint T-Mobile would have the same size and scale as Verizon and AT&T in terms of customers for the first time. And when you have a third competitor on that scale, what our record showed is there's going to be really big benefits for consumers in terms of the new competition you're going to see.
So, David, sounds like he is in favor. And any indication about how the rest of the FCC feels, despite the potential pushback from the DOJ?
No, I think you would expect, though, that the FCC is controlled by Ajit Pai, and there are 3 Republicans. You would expect if he is backing a deal that it will win approval, even if the 2 Democrats on the commission vote against it. The difference at the Justice Department is that it's one man's decision, Makin Delrahim, the head of the Antitrust Division. It's his and his only decision, and there's no committee. And so he was aggressive on AT&T and Time Warner. He really surprised a lot of deal watchers when he sued to block that deal, because those companies were not direct competitors. And here, on its face, I mean, this deal, putting aside the promises about 5G, would be anti-competitive, because it's combining 2 of the 4 national carriers, and this was a deal that DOJ opposed when it was proposed back in 2014.
So how much longer do we expect this will take to fully play out?
At this point, that's not clear. The DOJ does not have a shot clock like the FCC does. There could be a timing agreement where both sides have reached an agreement on when to come to a decision. Those are typically not public. I don't know of one here. And so they could take weeks, months before a decision is reached, or it could be much sooner than that. It's really hard to know.
And just on that note, I was going to say, on that note, I think one of the things that's important to remember is that the longer this takes, the more impact it has on the consumers, the staff, the employees, the dealers, and everybody else at both Sprint and T-Mobile, but more in particularly Sprint. So this is not a bottle of wine. This is not getting better with age. They need to make a decision on this fairly quickly to enable the people that are out there that are unsure, insecure about where they're going to be. So I think the decision that they made today to come out now, I think the DOJ needs to do something similar fairly quickly because, again, this insecurity is not good for consumers and it's definitely not good for the staff of Sprint.
Important point there. Peter Adderton, Boost Mobile founder, and our very own David McLaughlin. Thank you both. Well, Snap has announced Derek Anderson will take over the role of Chief Financial Officer. Anderson will take over the responsibilities of interim CFO Laura Sweet and report to CEO Evan Spiegel. Sweet has been named Chief People Officer and will oversee bringing in new talent. This, of course, significant given the executive turnover in the highest ranks at Snap. Coming up, the trickle-down effect from President Trump's battle with Huawei. Now, Google is suspending business with the Chinese tech giant. We'll discuss next. This is Bloomberg. Just last week, the Trump administration blacklisted Huawei and threatened to cut it off from the U.S. software and semiconductors it needs to make its products. The ban hamstrings the world's largest provider of networking gear and the #2 smartphone vendor in the world. At the same time, Huawei is facing multiple battles, including the arrest of its CFO in Canada, criminal charges, and a ban in the United States. This amid an increasingly hostile U.S.-China trade war. To discuss, I want to bring in Bloomberg Tech's Ben Brody in Washington, and with me here in San Francisco, Bloomberg Tech's Mark Bergen. So, Mark, you have some details on Alphabet in particular, and Google cutting off services and hardware already to Huawei.
Yeah, and Google's saying that the only statement they put out here is we're following the law. The confusing thing here is there are kind of two versions of Android, which is Google's operating system. One is the one that Google supports. It gives to key partners like Samsung and Huawei, which, as you said, is the #2 smartphone vendor in the world. And outside of China, that provides it with Gmail, Google Maps, YouTube, all the basic Google properties, as well as Google handles a lot of security. And so right now they're saying that in future phones that Huawei sells, they won't be able to have any of that, as well as access to Google's Play Store.
Right, they won't have Gmail.
Right, so they can have like certain
Google
versions
Play.
of those apps that are in the Android open source, but they're not as tightly controlled, and they're not something that Google can use to collect as much data and serve its bottom line, its advertising business.
Now, Ben, this story continues to develop by the minute. What is the very latest that we know about the U.S. position towards Huawei?
So just a minute or two before I came on, the Commerce Department, it seems, modified a little bit the restrictions on Huawei. It's an evolving situation, but it seems like they will be able to continue some of those existing business lines, such as with Google, and they'll be allowed to do some security patching and updates of their existing network infrastructure, and that's for about 90 days. So the exact details of this still remain to be seen, but I think the takeaway here, as you said, this is an evolving situation minute by minute. The Commerce Department has rulemaking to do around this. What exactly is permitted for us to bring in from Huawei, as well as for American companies to be selling to Huawei? Because remember, it's a two-pronged executive order, and there are restrictions on both of those issues. The Commerce Department is going to be making rules around that, and I expect that's over the next about 150 days. I expect a lot of lobbying around exactly what those rules mean and some of the terms in the executive order, what they do and do not allow.
Right, and you've had several U.S. chip makers, Qualcomm, Broadcom, plunge over the weekend, Friday, and into today, given some of these issues because they are big suppliers to Huawei. Mark, does what Ben just reported impact Google's position?
You know, I think the interesting place to look is Europe. Huawei has a pretty big business there. They've got decent market share in a lot of countries in Europe, as we know from last year. This big antitrust ruling around Android, but they told Google you can no longer bundle all your services like you do in the US, where you buy an Android phone, it comes with a suite of Google tools already in the phone. In Europe, Huawei has a chance to, and other carriers and partners and certainly rivals have a chance to jump in and sell their services. And It's a big test, right? You're seeing this sort of splinter net between China and the West, and there will be places like Europe, Latin America, where Huawei does have pretty big distribution, and it'd be really clear, like there's potential they could kind of move forward without Google.
I have a chart in the Bloomberg here which shows the impact that this has had on some of the suppliers to Huawei over the last couple of days. Ben, how do we expect the situation to evolve? Obviously, we're in the middle of a trade war, and it seems like positions on both the U.S. and China's side are hardening, and the U.S. government has said what's happening with Huawei has nothing to do with a trade war, but it's certainly hard to separate the two.
It is hard to separate the two, and it's a little bit disingenuous because, of course, trade negotiators always keep an idea about what a broad range of levers that they have are. They're not necessarily going to interfere in another agency's what they are doing, but they are aware of where they have vulnerabilities and strengths in engaging with another country. I think what's really instructive here is what ZTE went through when it was placed on this entity's list with a lot of restrictions last year. Basically, they had to go to the very highest levels. They basically had to get it on Donald Trump's desk, the president's desk himself, to get some of this reversed in the trade negotiations. It was a very similar overlap of national security issues and trade issues as the U.S. and China were trying to work on them in trade, seemingly kind of failing. I think what you're looking at now is a situation where trade talks have largely broken down between the U.S. and China, and I think that's why a lot of folks here in Washington are increasingly talking not just about a trade war, but a Cold War, an overall ramping up of tensions between China and the U.S. It's a very scary possibility, but it's something that increasingly folks around here are talking about.
Now, the question remains, how much will this actually hurt Huawei? And Huawei's CEO has said it's not going to hurt them that much. They've been stockpiling supplies. I mean, Mark, as the second biggest smartphone provider in the world that relies on Android, how much of a blow is this? Yeah,
I mean, it's not their core networking business. It's been a huge growth for them. You know, look back 5 years ago, they were nothing in the smartphone industry, and now they've surpassed Apple. They've been working a lot on their own components and chips. Google has proven that software is very difficult. Samsung has been trying. So that's going to be critical to their business moving forward.
All right, Bloomberg's Mark Bergen and Ben Brody in Washington. Thank you both. Obviously, we'll continue to follow the twists and turns here. Coming up, Tesla's problems just keep adding up. Why one analyst says the car maker is about to face hurricane-like headwinds next. Tesla stock took a beating Monday amid growing concerns over the company's road to profitability. Shares of the car maker plunged below $200 for the first time in more than 2 years after Wedbush analyst Dan Ives described Tesla's predicament as a code red situation and slashed his price target to $230. Ives also said he's got major concerns about underlying demand for the Model 3. Bloomberg's Jonathan Farrow spoke with Ives by phone soon after the stock started trading Tuesday. Take a listen.
First off, it comes down to demand, because the Model 3 demand does not start to uptick in the U.S. And especially in Europe, what we're seeing, it all comes down to profitability in the second half. And that's really the issue here. That's the concern of the street. And it's really a perfect storm that's forming for Tesla, which is concerning us more and more, which is why we lowered our price target.
So, Dan, I've got to be honest with you. 230 still sounds bullish, doesn't it?
Look, I mean, I think right now this continues to be a very difficult stock in terms of trying to get your arms around valuation, because if profitability does not come in the second half, they'll have to raise $1 to $2 billion more of capital, and then this starts to take another turn from there. So that's why right now we're still cautiously optimistic that they can get through this period. But I'll tell you right now, some hurricane-like headwinds from Musk and Tesla going forward. While they're focused on sci-fi projects like robotaxis and insurance instead of what the core bread and butter Tesla 3 demand.
So, Dan, let's talk a little bit more about your price target. Right now, this is feeding on itself. We're down more than 6%. We're at around 196, 197. You're looking for 230. Just acknowledge the biggest risk around that price target. What is it right now?
biggest risk, if profitability in the second half doesn't happen, all bets are off. Because at that point, they'll have to raise more capital, and the valuation continues to take a step downward. So I think it really comes down, not in the 2Q, but it's second half. They need to have profitability ramp. That's why Musk is reining in expenses left and right, because they know that. Because if second half they don't hit profitability, they'll have to go back to the capital markets for more capital.
Dan, when you say all bets are off, do you see a real risk that this just spirals out of control?
I mean, look, I think that obviously is more draconian, which right now we don't see that because they're well-funded. The core complex of Tesla continues to be there. I view this as just an extremely turbulent period.
Wedbush analyst Dan Ives this morning on Bloomberg Television. For more, I want to bring in Bloomberg's Dana Hall. So how are other analysts reacting to this?
Well, this was the only sort of price target that we saw lowered today. And I mean, Dan put out his note last night. So obviously it's sort of like a great way to start the week, right? When you lower your price target. And I guess what's interesting is that Dan just lowered his price target like less than a month ago from 365 to 270 to 275. So you're starting to see sort of back-to-back downgrades, which is unusual.
And pretty dramatic cuts.
Yeah. Dramatic cuts. And, you know, it just feels like a falling knife right now where, like, what are they going to do to change the story around? You've had all these negative catalysts. You had the NTSB report about another autopilot death. You have analyst downgrades. You have concerns about Model 3 demand.
Fires? Car battery fires?
There have been some car battery fires. To be fair, there are a lot of car battery fires involving ICE cars as well. But the sentiment just seems really negative, and we're not really going to get any data points from Tesla until early July when they reveal how many cars they delivered in the second quarter.
So lots of metaphors here, falling knife, as you just said, code red, as Dan Ives described. I've got a chart here in the Bloomberg which shows the way demand is shaping up for the Model 3, which is one of the things that Dan Ives says he is worried about. And Dan's forecast, as you can see, is lower than Tesla's. How does that compare with consensus?
So Tesla has said that they need to deliver they will deliver 90,000 to 100,000 cars in the second quarter. But I mean, they're delivering cars in the U.S., Europe, and China, and getting visibility into how that's actually going on all three continents has been really difficult. The company also says that they'll deliver 360,000 to 400,000 for the year. Dan Ives doesn't think they're going to make that, and if they don't make that, that's going to be a real problem.
And then the need for the capital raise.
Yeah, and they just raised $2.4 billion. I mean, that's why this downturn is so kind of incredible. They just raised $204 billion. In 9 of the last 10 trading days, they've closed down, and the company has lost 20% of its value since raising all that money.
All right, Dana Hall on the Tesla roller coaster for us. Thank you, as always.
Pleasure.
Coming up, chips down. President Trump's threat to choke off Huawei reverberates across the global supply chain. We're going to look at how component makers are faring. This is Bloomberg. Technology. I'm Emily Chang in San Francisco. Well, the impact of the Trump administration's threats to choke Huawei reverberated across the global supply chain Monday, hitting some of the biggest component makers. Chip makers including Intel, Qualcomm, Broadcom have told their employees they will not supply Huawei until further notice, and all has fallen over the course of the week. To discuss, we're joined by Bloomberg Tech Global Executive Editor Tom Giles and Bloomberg Tech's Ian King, who of course covers chips for us. So Ian, what's happening inside these chip companies?
Yeah, I mean, the general counsels, the people who, police this kind of matter are telling employees, look, for now, until we get a resolution of this dispute, we don't do business with Huawei, so no more orders, no more business contact, all of those kind of things. So they're really just shutting down their relationship with Huawei.
How much could this hurt these U.S. companies? I mean, the irony is the U.S. is trying to deal a blow to Huawei, but certainly if you're looking at the stock, it's not good for Qualcomm, Broadcom, et cetera.
No, well, you remember you and I had that conversation about be careful what you wish for. These companies have been lobbying for years saying, we need to look at what China's doing in terms of our IP. But in that period, China has become more and more important to them. And frankly, Huawei is the gateway to it all. It's the biggest IT company in China. If you want to build a 5G network, Huawei is going to have to be the equipment provider there. So really, that's what you're seeing reflected in the market today. Investors are justifiably concerned about the kind of boomerang effect of this.
There's a concern, Tom, that the U.S. seems more concerned with slowing China down than speeding the U.S. up. What does this mean for 5G, given that Huawei does, almost universally people believe, have the best 5G equipment?
At the lowest price, right. So if you want to roll out your 5G network on time, you need Huawei as a provider. So to the extent that U.S. companies, and it's really not the big telecom companies because they've already vowed we're not going to do business with them, it's some of the smaller carriers in rural areas that could be affected because they have not made that same commitment to not buy 5G equipment from Huawei. And don't forget, to build its gear, Huawei needs some of these chips and other components from U.S. carriers. So if you're a global company and you're reliant on Huawei, whether you're part of the ban or not, you still need the Huawei equipment for your 5G rollout. And so anything that impedes Huawei from making its own gear, chips from U.S. chip makers, for example, that threatens the 5G rollout globally. And that has implications for a cutting-edge technology that's supposed to provide, ubiquitous wireless technology to people everywhere. So people outside the U.S. and inside the U.S. are going to be affected if 5G somehow is impeded by this ban on Huawei.
Are the chip makers concerned, Ian?
Oh, absolutely. I mean, you saw, they won't say it publicly because you don't want to get on the wrong side of this administration, but you saw messages coming out of the Semiconductor Industry Association, which I was told behind the scenes was basically, this is what we want you to say, go and say this in public. And what they said was, yes, we want action, yes, we want our IP protected, but we'd prefer it if you kind of did it in consultation with us, if we took a more measured, it was a very, it was written by lawyers who are clearly trying to tone down a very concerned group of companies.
Tom, how much will this actually hurt Huawei? Because there's some dispute about that.
Well, so Huawei has taken steps. We've spoken to people close to the company who've told us that they have stockpiled a certain number of months' supply of a lot of this critical equipment. So if this is all just bluffing on the part of the Trump administration as a way of gaining leverage in trade negotiations with China, and it's all very temporary, that is a possibility. People close to Huawei say they've taken precautions. Now, should this become a real long-standing ban, that does have big implications for Huawei and its ability to do business globally. It's reliant on U.S. suppliers. And if you tell U.S. suppliers, small and big chip makers alike, software providers, we haven't even talked about Google, that has big implications for Huawei's global business over the long term.
So how long are the chip makers preparing for this to last?
Well, that's a good question to build on what Tom just said. You don't go to Intel and say, can I have a chip, please, and they give you one, right? You have to order these things in batches of thousands. They take as long as 3 months to make a microprocessor. So the longer this goes on, the bigger the logjam, the worse kind of effect it gets, the bigger hairball it becomes, and the longer these things become delayed.
Tom, what's next? Obviously Huawei is facing this issue with its CFO, who's still under house arrest in Canada.
That's right.
The U.S. is trying to extradite her.
Right. I think we look at whether this is just a negotiating tactic, whether they're just a pawn in the U.S.-China trade negotiations. But longer term, I think what you're seeing fundamentally is U.S. companies are beginning to question the viability of the existing supply chain, much of which goes through China. Right now, a lot of U.S. companies are asking the question of, can we rely on, given the politics, given the security concerns, given the question marks that the U.S. administration, U.S. government is putting around Chinese suppliers, can we and should we continue to rely on China, mainland China, the way we have for so many years? And the question increasingly is becoming no. And so we're talking to a lot of U.S. companies that are looking, where do we, for the long term, think about where we're going to source our materials, our components outside of China. And you're going to see a lot more of that in the coming months.
Fascinating and complex situation here. Ian King, Tom Giles, thank you. All right, well, Morgan Stanley banker Michael Grimes has spearheaded some of the biggest tech deals of the decade, including Facebook, Zynga, and Twitter. He was also at the center of Uber's tumultuous listing. Now the so-called Silicon Valley whisperer is looking for his next big deal as unicorns like Airbnb look to get to the public markets. But how damaged is his reputation post-Uber? Joining us to discuss from New York, we've got Bloomberg's Sonali Balsik. So first of all, Sonali, Michael Grimes is sort of legendary inside the Silicon Valley bubble. You know, anyone who's had conversations with tech bankers knows who he is. So first of all, tell us a little bit about who Michael Grimes is and his history in Silicon Valley.
Right, so he's seen as the next Frank Quattrone, right? He's seen as somebody who works on the biggest tech IPOs. You know, most banks go out and bring their CEOs of the banks out there, but Michael Grimes takes the business himself. So he's really competing in Silicon Valley with Jamie Dimon, with David Solomon of Goldman Sachs. And so, you know, you have somebody who's, you know, spearheading this Menlo Park office by himself, really close to Silicon Valley, trained as an engineer. But then you go back and you look in New York and, you know, you have some investors here that are also pretty upset with A, how much money they've lost on Uber so far, but B, unimpressed with this kind of rosy picture of Silicon Valley that's been painted at some of these pre-IPO roadshows.
So what happened with Uber and how much is he being blamed? Because I certainly had sources who said to me, Morgan Stanley messed this up.
It's certainly in both ways, right? Because on one hand, people are a little upset with Morgan Stanley, certainly the investors that have bought in 2016 at the $48 price, and then certainly investors who have bought in at the $45 hot IPO, including, by the way, Morgan Stanley's own clients. A pitch Michael Grimes uses is Morgan Stanley's network of more than 15,000 financial advisors, which has a large retail base of clients. And so, you know, you have mom and pop investing here. You have some major investors also investing. People are upset with Morgan Stanley, but then a lot of clients are also saying, well, wait a minute, they still raised more than $8 billion for Uber. And so the company should be happy because they raised the most amount of money possible in this kind of environment.
Now, Michael Grimes also ran Facebook's IPO, which was notoriously not great as well. There was a glitch on the NASDAQ. Seemed to be like there was too much demand and they couldn't handle it. How is that, coupled with what's happened with Uber, going to impact Grimes and Morgan Stanley's ability to win new tech deals?
That's certainly the question here. Something that's interesting, if you look back at Facebook, all the rivals thought that they were going to steal the business right away. But really, within 6 months, Morgan Stanley was still at the top of all these lead listings. Remember, Morgan Stanley is also the #1 stock trading firm in the world. And so, you know, you need to kind of have them on your side here because a lot of trading flow is going to go through Morgan Stanley, as well as Goldman Sachs, as well as JP Morgan. And so really shutting them out of the game doesn't really happen because they have such, you know, they were one of the longest standing banks in Silicon Valley, at least of their size. And so you're not going to shut out Morgan Stanley completely, but you know, if Facebook is any indication, and Facebook, by the way, was much worse than Uber, they were back in the game within 6 months.
All right, well, Uber shares have recovered a little from that opening, but we'll be watching over the next few months to see where they end up. Bloomberg's Sonali Balsik, thank you so much for that report. Coming up, a former Snap exec and top investment banker wants to take on Amazon. We're going to talk to the CEO of Verishop, Imran Khan, about his new venture. This is Bloomberg. It was a graduation gift that no one knew was coming. Robert Smith, the founder and CEO of Vista Equity Partners, delivered the commencement address at Morehouse College this weekend. And in front of 396 graduates of the historically black all-men's college in Atlanta, the billionaire investor and richest African-American in the United States, African-American man, that is, told the crowd he was forgiving their student debt.
My family is making a grant to eliminate their student loans. I know my class will make sure they pay this forward. And I want my class to look at these alumnus, these beautiful Morehouse brothers, and let's make sure every class has the same opportunity going forward.
Pretty amazing. Smith joined Goldman Sachs as a tech investment banker back in 1994, working in New York and then San Francisco before leaving to start Vista in 2000, which of course focuses on enterprise software. Well, my next guest wants to, quote, bring back the joy of online shopping while also taking aim at Amazon. But is it really possible to shake up a marketplace that's already so crowded and dominated by one major platform? I want to bring in Imran Khan, Verishop co-founder and CEO. Before launching Verishop, Khan was the chief strategy officer at Snap and a longtime investment banker at Credit Suisse. Imran, good to have you back. I've known you through both of those professions, but it's been a while. So I'm sure you've been thinking a lot about what you wanted to do next. Why this?
Yeah, I think if you look at e-commerce is now only 9% of overall retail market. I believe that over the next decade, 30 to 40% of all retail will be online. And if you look at, there are not that many consumer choices when you look for buying branded product or having better experience, better way to discover product. So we think there's a lot of opportunity to innovate. If you look at markets like China, for example, where 25% of the market is e-commerce, there are many more players in China compared to in the US. So I think there's a better way to bring joy in a consumer mind when they're trying to buy things.
You obviously focused on a younger audience at Snap. Is there something that you learned there in terms of a need that wasn't being met in e-commerce?
Yes, absolutely. You know, I think if you look at millennials, they like to do more research before they buy something. You know, they also care about responsibility in terms of shopping. They care about economy. They care about sustainability. And I think if you as a consumer, for example, if you want to buy sustainable product, where do you really go? So we have a lot of different ways of discover product. You know, if you look at on our platform, we will have around 200 different attributes, way of you finding products. So I think I'm really excited to bring in new way of shopping to consumers. And the market is very large, and I think it can accommodate a lot of players.
So what makes you think you can take on Amazon, which already has scale and convenience? I mean, they're going from 2 to 1 day shipping.
Yeah, so first of all, I really admire Amazon, and I'm a shareholder of Amazon personally and through my fund. However, I think as e-commerce goes from 10% to 40%, not one company cannot solve everything. You know, and Amazon is also a juggernaut now. They do software, they do a lot of different things, and again, really admire the company. But there are a lot of parts of e-commerce is not being addressed by existing players, and I think we can bring that. Like, for example, discovery, you know, because e-commerce still very much intent-based. So I think we can give consumer a lot of different ways to discover new products.
Your wife and also your co-founder also worked at Amazon for many years. So what sort of secrets is she bringing to the table?
No secret, you know. I think, you know, again, Amazon is a very large company. She worked at one of their subsidiaries, and she learned a lot from there. And I think, you know, it's great to work with her.
So obviously you helped take Snap public. Before that, you took many companies public, including Alibaba, which is, you know, another e-commerce company. I have to ask for your thoughts on what's happening in the public markets right now. We were just talking about what went wrong with Uber, and I'm sure you were watching from afar. What's your take on what happened there?
At Uber? Mm-hmm. I think, you know, I don't want to specifically talk about Uber, but I think if you look at the recent IPO trends, one thing that really stood out to me, one is that market is really differentiating companies that has more ability to make money or has more probability of making money versus the companies will have to raise money again in a near future or potentially have to raise money in the near future. And I think it makes sense, right? Because we're in an economic cycle. You don't probably want to write unlimited check to companies. So I think if you look at some of the companies that are profitable, like Zoom did really well. Companies that are actually not making money and has no near-term profitability didn't do very well. So I think market is really telling these companies that, look, you guys have been around for a long time. At some point, you have to make money.
So do you think then that there's a sort of reckoning coming for tech companies in particular, which have historically gone to market without being profitable?
Yeah,
Amazon's one of them.
Yeah, but look, Amazon is always being funded their business through their own cash flow. They didn't have to go raise money from a third-party capital. You know, I don't even remember when is the last time Amazon went and raised capital. But I think and even if they raised, it was more of a point of strength as opposed to point of weakness. So I think the big thing is, I think we lived through 10 years of bull market, and I think a lot of these companies are involved in many different initiatives, but at some point they have to prioritize and what's going to drive more profitability, or at least you need to show what's your path to profitability is.
So you spend a lot of time sourcing tech deals in China. I mean, how much do you think what's happening in the public markets is because of the fundamentals of these companies and because of what's going on between the United States and China?
In terms of China, yeah, look, I think trade war is not good for anyone, but I think at some point, I think all trade relationship has to be based on mutual respect and which helps. And I think, everybody agrees that over the last decade, some of the relationship U.S. was a disadvantageous situation. So I think in a current economic environment, given the U.S. strength, it makes sense that U.S. will engage in a trade negotiation. And I think it is a bipartisan viewpoint at this point that we need more respectful mutual relationship with China and all of our trade partners.
So how optimistic are you that the relationship will get better, or do you think it's only going to get?
I think it's a interest of both parties to come into a relationship. So I think when it's interest of both parties, there will be a relationship. But like any situation, it is a tough negotiation, and there's a lot of things to work through. And again, I'm not very close to that situation, but I'm optimistic there will be a good outcome. But obviously, it will take some time, and I think again, it's in interest for both parties.
So, also have to ask you about Snap. They just named a new CFO. There has been a lot of concern about executive turnover at Snap, including the former CFO. What's happening?
Look, I think Snap has been forefront of innovating in consumer space, and I think and Evan and his team has done a really good job assembling a great team. And I think like any company that grows fast, there are some positive, there are some negatives, right? When I joined the company, we had zero revenue. When I left that Q4, we did $1.6 billion annualized revenue. So did everything goes always right? No. Does it right for every employee? No. But I think the company continued to innovate and build great products. Again, I'm full disclosure, I'm still a shareholder. So, I think, and I'm looking forward to see what the Evan and team will do in future.
So as a shareholder, Facebook's position is compromised right now by a number of different controversies and scandals, though Instagram still appears to be strong. How optimistic are you that Snap could win back some of the users it's lost to Facebook and Instagram, or further disrupt social networking?
Yeah, you will really gonna dislike me. I'm also a shareholder of Facebook through my fund. But I think the key thing to keep in mind is the time spent on mobile devices only going to grow. And I think this is the thing that I think the market narrative is always, it's a zero-sum game. Oh, you are coming in, Verisure versus Amazon, or Snap versus Facebook. Those are great stories, but ultimately I think is that I fundamentally believe that all of us are in the right side of the history, in a sense like people are spending more and more time on digitally. And people spend more and more time digitally, there will be a lot more new businesses. Not one company will take everything. It's just impossible for one company to solve every problem. And Facebook does a great job with Instagram, and Snap has done a great job with camera. And I think, one will be bigger or others will be smaller. That only time will say. But I think both can coexist very well.
Okay, so let's talk about Verishop, because Amazon, you're right, isn't the only competitor in e-commerce.
Right.
We've seen Walmart making moves. We see these sort of niche e-commerce companies, focusing on brand, and that has worked for some companies. When you launch when are you going to launch?
Late June, early July.
What are we going to see?
I think you will see that our commitment in 4 areas. Number 1 is trust, because most of these e-commerce players are marketplace. And when you are in a marketplace where anybody can go list something or anybody can post something, the platform is prone to counterfeit and fraud. We saw that with eBay. We saw that with Facebook, with Russian. We saw that with Taobao in China. So I think what we're doing is we're acquiring all the product directly from the brands by guaranteeing everything you're buying is real. And I think trust is going to become an important topic of internet, because over the last 25 years, internet was built on the premise of open platform. And we saw when everything is open and there's no rules, it brings chaos. So I think we're building all the product you're finding is real. We're standing by that because we source it directly from the brands. Second thing is discovering new product. Because again, internet is very much intent-based, so we are giving consumer more choices to discover product, so we through a lot of different ways that you will see. And then the third is we're going to continue to make a big commitment on convenience, and I know Amazon and other companies does it, but we're going to continue to do so because 2-day free shipping, free return, all those kind of things. So I think, so we're excited, and again, it's just the beginning. It takes a long time to build a business, and hopefully we'll continue to bring new product and new innovation to the platform.
All right, Imran Khan, co-founder and CEO of Verishop, will be watching in late June or July.
Thank you. Hopefully you'll shop.
For the launch, absolutely. Well, it is something I love to do. So, thank you. Still ahead, Toshiba has spun off its chip businesses and it's said to buy out shares in major tech companies. We will dive deeper next. This is Bloomberg. Toshiba Memory will buy out the preferred shares in the chip maker held by Apple, Dell, and other investors. This according to the Wall Street Journal. Apple and Dell will join Kingston Technology and Seagate in selling their shares to Toshiba Memory for about $4.5 billion. The U.S. tech companies were part of a group led by Bain Capital that took over the memory chip maker from former parent Toshiba Corporation. Sony's agreement to partner with Microsoft on cloud gaming wasn't just a surprise to the industry, it also shocked Sony's PlayStation division. The unit spent almost 2 decades fighting Microsoft in the video console market. PlayStation spent 7 years trying to develop a cloud gaming product, but had little success. And finally, HBO is now plotting a post-Game of Thrones future. Sob. Last night, the network aired the series finale of its most popular show ever. Fans should not despair, though. There will be a Game of Thrones prequel under the new owner, AT&T. HBO will ramp up original programming this year by 50%. The company also revealed the series finale of the show was watched by 19.3 million viewers. But will it be as good? That is the question. That does it for this edition of Bloomberg Technology. On Tuesday's show, we're going to be speaking with Myron Brilliant, head of international affairs at the U.S. Chamber of Commerce, and talk about the trade war with China. This is Bloomberg.